learners. Welcome to today's accounting class. My name is Mr. Simbi, and this lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. In today's class, we are going to have revision for the paper 1 exam that is just around the corner. So please make sure that you have somewhere to write. You need to have a pen. You also need a calculator because we're going to do so many calculations today. I'm going to be focusing on paper 1 revision. All right. So here are my objectives for today's lesson. I am going to look at the structure of paper 1. If you have been wondering what comes in paper 1, today I'm going to address that. I am going to look at the statement of comprehensive income. I will also do the statement of financial position. I will not do a complete one, but I'll do adjustments in how they affect this statement. I'll also touch the cash flow statement calculations. I will not do the entire cash flow statement, but I will touch on particular calculations that affect the cash flow statement. Here is the structure of our paper 1. When we are looking at our paper 1, we have topics that will come in paper 1, and these topics are the calculation of correct net profit after tax and the statement of financial position. So you will find that question 1 has several ways in which it can be asked, and one of the options is whereby you have the calculation of correct net profit after tax and the statement of financial position. And in the statement of financial position, you can be asked to complete either the equity section or the assets section. The section that we're sure is going to come would be your cash flow statement, and then the analysis and interpretation of financial statements, and also auditing and corporate governance. So in today's class, I'll focus on these main two first. The other option that can come on question number 1 would be your statement of comprehensive income and the statement of financial position. So this would be a full income statement then, the statement of comprehensive income, and then the statement of financial position. You can either get the equity or the assets section, depending on what the examiner is testing us on. But these are all possibilities. And then you will find, as I said earlier on, that question 1 can be structured in about 4 different ways. So I've spoken about 2 already. And the other option that can come is when we are given the statement of financial position, as well as looking into the notes that affect this statement. So this is another option that can be exploited by the examiner. So you need to go to the examination well prepared, all right? And then the other option is when we can have the statement of comprehensive income and the notes. So you will see that the other 3, I have left them constant. What was changing was the question 1, all right? Those are the areas where I was changing. And I gave you several options of what can come in there. The first option was when we can have the calculation of correct net profit, and then we have the statement of financial position. That was the first option that we spoke about. And we also spoke about option number 2, where you can have the statement of financial position. And in option number 3, we also had the option where you have the statement of comprehensive income and the statement of financial position as well. And then this is the last option that I'll speak of, where you have the statement of comprehensive income and notes. So when you are preparing for your exam, make sure that you prepare fully, such that when you get to the exam center, you are able to answer questions. One thing that I want to encourage you is not to leave any question unattempted. You need to attempt all the questions that you find in your exam paper. Make sure that you are fully prepared. You can only be fully prepared when you practice. In today's class, we're going to look at several activities, but activity 1 is extracted from the NSC June 2023 paper 1. So from this paper, we are going to do some questions. Activity 1 then reads, Starlight Limited. The information relates to the financial year ended 28 February 2023. The company trades in electrical items. Required 1.2.1. Refer to information B. Number 1. Calculate the value of closing stock of light bulbs on 28 February 2023 using the weighted average method. This is very important. You can see that we are in paper 1, yet we have a topic which is normally seen in your paper 2, that is your inventory valuation method. It therefore means when you go to write your paper 1, you should go there knowing your inventory valuation methods. Remember the 3. We have the specific identification, we have the weighted average, as well as the FIFO, the first in, first out. In this particular paper, they wanted us to use the weighted average method as we answer question 1.2.1. And here is the information that we were provided. We have trading stock, which is 2,969,800. Remember, this is your 2023. This is one very important aspect that you take notice that this is your 2022 and your 2023 is to your left. Do not make mistake of not seeing that aspect. Very important. And then we have adjustments that relate to this question. It says, a physical stock count on 28 February. This is the last day of the financial year now, the end of this financial year. We did a physical stock count that revealed 2,774,800 stock on hand. So we have this stock on hand. However, this figure excludes the closing stock figure for light bulbs. So this figure does not include the closing stock for light bulbs. And we need to consider that when an amount is not included, we need to include it then. And then it says, note that the weighted average method is used to value the light bulbs. And then we're given the information that relates to the light bulbs is as follows. All right. Now, what do we need to do? We need to calculate. What we need to do is to calculate the value of closing stock, which has not been included, such that we know how much is our stock after that amount is included. Let's do that. All right. So the first thing that we are going to look at is the method of valuation. Here we're told that we're using the weighted average method. When we use the weighted average method, it is very important to know your formula. All right. So I would have a line here, and then I would have my rands over my units, my rands over my units. And in this question, it has been made very easy because I am given the goods available for sale, which is my 3,894,000. So I'll come here, then I'll say over my rands, I have my 3,894,000. This is my goods available for sale. The number of units that relates to this 3 million is this 55,000. So I'll come to the bottom, then I'll say 55,000. All right. And then I also see that there is carriage on purchases which needs to be added. So I'll come and I'll add my carriage. So I'll say plus my 27,500. That is my carriage. Once I add this and that, and I divide it with that, it should give me the average price per unit. The average price per unit. So if we punch this in our calculator, you will realize that we'll end up with 71 Rand 30. 71 Rand 30. This becomes the average price per unit. Now we need to know how many units do we have as our closing stock. So you come here, we are told that the stock on the 28th of February is 1,700. So I'll then say my 71 Rand 30, multiply that by the 1,700, which is the number of units at the end. If I punch that in my calculator, I would then get 121,210. This then is the value of stock that was not recorded. This is the value of the light bulbs that was not recorded, the amount that was excluded from the closing stock figure. All right, so there is the typed version of how I got my 121,210. Once you have that, once you have your 121,210, we now need to go and record it. We now need to go and record it. So it therefore means that my stock at the end of the year is no longer only 2,774,800, because I have an amount that I need to include now. I have an amount that I need to include. So let's come and then we will now say, I have that amount, which is my 2,774,800. But I now know that this stock which was excluded has a value, and the value of the stock that was excluded is 121,210. So if I take these amounts and I add them, it simply means my stock on hand, therefore becomes 2,800,000. I'm adding this and that. So I'll end up with 2,896,010. 2,896,010. This is the value of stock on hand. 2,896,010. However, we understand that we will have stock on hand and stock in the business books. All right, let me repeat that. We will have stock in the business books. This is your trading stock in the trial balance. The stock according to the business books. So the stock according to the business books or the records show that we have 2,969,800. This is the stock according to the business books. However, we have done a physical stock taking now, and we have seen that after the physical stock taking, we have stock on hand. And the stock on hand is 2,896,010. So we have two different figures here. We have stock according to the business records, stock on the business records, but after a physical stock take, we realize stock on hand is 2,896,010. Therefore, these two amounts are not agreeing. We will now either have a trading stock surplus or a trading stock deficit. I'm going to ask you this. What do you think it's going to be when stock that we believe we must be having is 2,969,000? This is what the business books are saying we must have. But when we go and count the stock, we realize we don't have that. We actually have 2,896,000. That means our stock on hand is less. Once your stock on hand is less, it means you now have what is known as a trading stock deficit. Once your stock on hand is less than the stock that is on records, you have a trading stock deficit. But if the stock on hand was more than the stock in the business records, it was going to be a trading stock surplus. You're very correct. trading stock surplus. But what we're sitting with in this question is a trading stock deficit. How much is that deficit? So we are now going to get the difference between our 2,896,800, which is in the business books, and the 2,896,000, which is on hand. Therefore, when I come here, remember, we have already done that. So when I come here, I'm now calculating my trading stock deficit. Remember, we have already added these two, and they give us 2 million. Remember, we've done this. They give us 2,896,010. So the difference between the on hand and the one in the trial balance shows us that we have a trading stock deficit of 73,790. Once we have a deficit, it is an expense to the business. A deficit, it is an expense to the business. So you bring it under your operating expenses. My dear learners, I want to encourage you to open brackets when we are writing our exam, because I need to see the amount that is in the trial balance and you show me the amount that is in the adjustment as well as the last adjustment. Then you show me your trading stock deficit. That is very, very important. According to the demands of this question, you would then answer the current assets part. This is what this particular question wanted. Remember, I gave you several options that the examiner can bring. In this paper, the examiner was exploiting the statement of comprehensive income and a part of the statement of financial position. In the part of the statement of financial position, the examiner wanted us to address our assets. So here you're going to have the current assets. And then we're going to speak to inventories. Remember, this is your note 4. So we would then say the amount that we had on hand before we added the amount that was excluded. Then we bring the amount that was excluded, which is that one. Then we end up with 2,896,010. There was another way that you could have done it, but this is the simplest way. And I'm not going to show you the other way. I'm just going to stick to this one. All right. So this is how you would show it in your statement of financial position. Remember, we are in the assets part. What do you show? You show the stock on hand. Here, we want to see the on hand. This is what is shown in the final column. All right, let's move on to the next adjustment and we see what the examiner wanted us to do. It says, required, calculate the profit or loss on disposal of vehicle. I like this kind of adjustments. Be ready. Make sure your calculator is closed. Let's see what they want us to do. Calculate the profit or loss on disposal of this vehicle. So if you read this question, it says an old vehicle was sold for 91.5 on 30 November. The amount received was recorded, but no further entries were made. Details of the vehicle sold, carrying value, depreciation. And when you look at this information, you don't see the cost of the asset. You would think that something is wrong. No, nothing is wrong. Everything you need is provided here. So what we understand is I am given the carrying value, which is 104. This is the worth of the asset. The asset is worth 104 at the moment. All right. This is at the beginning of the financial year, 104,000. Now, we sold it on the 30th of November, not on the 1st of March. That means we have used this asset. Once we have used it, it will lose value due to depreciation, which therefore means what it is worth at the beginning of the financial year is not what it is worth when we are selling it. So now we need to know what is it worth when we're selling it. So we need to subtract depreciation from the carrying value. Which method are we using? The diminishing balance. This is easy because I know with my diminishing balance, I calculate depreciation on the carrying value. Let's take the carrying value. So my carrying value is given, which is my 104,000. So I'll come here and then I'm going to say 104,000 104,000. Then I now need to multiply this by the rate, which is 20 over 100 times the number of months. We are counting from the beginning of the financial period, which is March, until the date of sale, 30 November. So you need to use your fingers here. You need to use your fingers. Don't assume it's 6 months. Don't assume it's 7. Literally count. And when you have done that, you will realize that we have 9 over 12. This will give us depreciation, which is 15,600. This is the depreciation of this asset in this year of sale. So it has lost 15.6. If it has lost 15.6, yet at the beginning it had a carrying value of 104,000, what is its carrying value then? So we'll now say 104,000 minus 15,600. And this will give us the new carrying value, which is 88,400. So this asset, on the date of sale, it has a carrying value of 88,400. But how much are we selling it for? We are selling it for 91,500. All right? So we will then say, if we're selling it for 91,500, we're getting 91.5. For an asset that is worth 88.4. That means we are getting more than what it is worth. If we're getting more than what it is worth, therefore it is profit. And the difference here is 3,100. This becomes your profit. Are we together? So here it is when it is neatly typed out. Remember the 104 minus the depreciation. And then you subtract what we've sold it for. So we end up with the 3,100, which is your profit. Okay, so that becomes the profit on sale of the vehicle. That is your answer. All right, remember, if you're preparing the statement of comprehensive income, this will go to other operating income, profit on sale of vehicle. Let me move on to the next adjustment. The next adjustment then says, calculate the total depreciation for the year. Calculate the total depreciation for the year. You understand that when we're calculating total depreciation for the year, you will remember the SUN. The SUN. The SUN stands for your sold, your old, and your new. So for the sold, we already know. For the sold, we already have our 15,600. You remember that one? For the sold, we already have 15,600. That was given to us. 15.6. No, we calculated. Yes, we calculated just now. What was given is the depreciation of the remaining vehicles. What was given is the depreciation of the remaining vehicles. Okay, so we have the old, and the old are 145,200. So we're just going to add this, my 15.6 plus my 145.2. And if you look over here, I have it. All right. Here's the depreciation of the sold. And if you come here, I have my 15.6. I have that one. Then I end up with 160,800. This is my depreciation on the vehicles. Okay. Let's go and see if we can calculate depreciation for equipment. We are told equipment is depreciated at 15% per annum on cost. That therefore means I need to calculate depreciation. Remember what I said earlier on. When we calculate depreciation, we need to remember the SUN. What does the S stand for? Sold. The O, old. And lastly, the N, new. All right. So here we can see that we have no equipment sold. But what we have is a change. Someone is saying, where do you see the change, Mr. Simbi? If you look at the year 2022, our equipment was 774,000. But when you come to 2023, our equipment is now 822,000. Our equipment has increased. What could have caused that? Definitely, we bought new equipment. So here we're going to have the old and the new. The old is easy, what we had from the beginning. So my owed is 774,000. I'm going to come in and say 774,000 multiplied by the depreciation rate of 15%. The owed will always be there, 12 over 12, multiplied by 12 over 12. Therefore, this owed has depreciation of 116,100. This is the depreciation for the owed. Now, we need depreciation for the new. Do we know the cost price of the new? We don't. All right. So we now need to go and get the cost price of the new. To get the cost price of the new, we will now say the equipment amount at the end of the year, 822,000. Then I subtract the 774,000, what was there at the beginning. The difference between these two amounts will be 48,000. This 48,000 therefore becomes the cost of the new equipment. So I have my cost here then, which is my 48,000. This is the cost of the new equipment. Then I now say, if I have my cost, I know my rate is 15%. That's easy, 15 over 100. And I now need to know for how many months I had it. Remember, with the new, you count from the time it was bought. And here they say the 31st of July. Already you know, if it's the 31st of July, do we count July? No, we start counting from August. So we're going to count from August until the end of the year, which is February. And if you count properly, you get 7 over 12. Please remember what I said. Use your fingers. Do it properly. And then if you punch this in your calculator, dear learners, please tell me how much you get. Let me count the figures for you. You say 48,000 multiply by 15 over 100 times 7 over 12. If you do punch those figures properly in the calculator, you get 4,200. One word of warning. Take a calculator that you are familiar with to the exam. Don't put a calculator in the morning. Make sure you take a calculator that you've been using all the time so that you don't get surprises. So here you have your 4,200. Remember, it is your old and your new. So your old is 116,100 and the new is 4,200. So I'm going to add these two amounts then. I'm now going to say 116,100 plus the 4,200. And then the total will give me 120,300. This becomes the total depreciation for my equipment. So when I come to the depreciation on equipment, remember, I have my 120.3. But in the statement of comprehensive income, I need to record depreciation. Therefore, I will have my depreciation for my vehicles and my depreciation for my equipment. And then I'll end up with the total. Depreciation is an expense, so you will find it under your operating expenses. Can I move on? Okay, let's go to the next one. The next one says bad debts. Received 9,000. This is what we have received from the insolvent estate of debtor Billy Kroon. So insolvent simply means the debtor can no longer pay their accounts. However, they have given us 9,000. His estate paid 80 cents in the rand. Okay, what we understand is the entire debt, what this guy was owing us, was 100 cents. This is what the guy was owing us. And then they have paid us 80 cents. And that 80 cents is equal to 9,000 rands. Okay? Now, what we will not get from them is 20 cents. This is what they then say the balance of his account must be written off. Once we talk about writing off, we are talking about bad debts. So the amount that must be written off is which amount? The entire debt was 100. They've paid us 80. How much are we not going to get? 20. So what we will not get is 20. Now we use that method. You remember which one? Okay. So we now say what we want goes on top. So we want 20. And what do we have? We have 80 multiply by 9,000. Okay, let's punch that in our calculators. How much do we get? We get 2,250. What is that? This becomes our bad debts, 2,250. Once we have bad debts, you have to understand it affects two accounts. All right, it affects the income statement. It also affects the balance sheet. I'm talking of the statement of comprehensive income and the statement of financial position. Let's see how it will affect the statement of comprehensive income. We come under our operating expenses, bad debts, 16,200, the one in the trial balance, plus the bad debts that we are going to write off in this time now. So we end up with 18,450. How is it going to affect my statement of financial position? This is how it's going to affect. I have my debtors control, which is 645,250, and then I'll come and subtract the 2,250, which is my bad debts. Okay, next adjustment. Let's go. The next adjustment reads, the provision for bad debts must be increased to 25,720. All right. I saw when I say the provision for bad debts, most of you paid attention. You want to hear how we are going to do this adjustment. Normally, I would say, once you see an adjustment like this, and it says the provision for bad debts must be increased to this two, so we're going to have two terms here. We have to and we have by. If they say provision for bad debts has been adjusted to, the to amount goes to your statement of financial position, the balance sheet. But the increase or decrease by, this is what goes to your statement of comprehensive income statement. All right, let's now see. If we are to start with the statement of comprehensive income, what do? You have to understand, I'm just going to simplify it a bit. In the statement of comprehensive income, we only record either the increase or the decrease, whereby an increase is an expense, but a decrease in provision is income. How do we know whether we have an increase or a decrease? We will now say, how much was the provision last year? Last year, which is 2022. Last year, it was 21,020. But this year, we have been told that it must be increased. So already we know we are dealing with an expense. An expense. Why? Because it must be increased. So this year, it is 25,720. So the difference between these two amounts is 4,700. Once we have the difference in the statement of comprehensive income, we record the difference, that is either the increase or the decrease between last year and this year. And we already know it's an increase, so it is an expense. So it therefore means I'll come here under my operating expenses, and then I'm going to say provision for bad debts adjustment, and then my amount is going to become 4,700. What did Mr. Cindy forget to do? Sure, calculation. So I must have opened a bracket here and say 25,720 minus 21,020. I close the bracket. Then my teacher will know this is how I got the 4,700. This is what I do in the income statement. But when I go to my statement of financial position, which is the balance sheet, I will come here and I will now say 645,250, which remember we have already got that one, and the bad debts. So I'm continuing. I'll come and minus the 25,720. What is this 25,720? The provision for bad debts adjusted to. Remember we said the 2 goes to the balance sheet. So I come and I subtract the full amount as you see over there. That is what we will do. Okay, can I move on to the next adjustment? The next adjustment reads, director's fees. I love this kind of adjustments. It says, the company has 2 directors who were appointed in 2019. They're trying to tell us that these guys were there from the past. Okay, let's see who are these 2 directors. So here is director number 1, here is director number 2. 2 directors were there from the past, from the beginning. All right. A 3rd director was appointed on the 1st of October. Here's the 3rd director. So we have director number 3 on the 1st of October. The directors all earn the same monthly fee. Very important. Directors' fees paid during the financial year have been recorded, but one director has already been paid for March and April. The financial year is ending when? In February. So that means director number 1 here has not received for 12 months, but has received for 14 months. Why 14? Because the director has received for March and April. So this director here has received for 14 months. But the second director here has received for what? 12. And this is the new guy. Remember, this is the new director. The new director was appointed when? 1st of October. So we count from October until the end of the financial year, which is February. That gives us how many months? 5 months. In total, we are now saying the 14 plus the 12 plus the 5. That will give us 31 months that we have paid. That we have paid. It means this 2,015,000, this 2,015,000 is for 31 months. How much is the director's fees per month? It will become 65,000 per month, per director, per month, per director. So our problem is this first director here, he has received for 14 months. Was he supposed to get for 14 months? No, he was supposed to get for 12 months. So we'll multiply this by 2, then we get 130,000. That becomes my prepaid expense. So I'll come here and I'll say my 2,015,000 in the trial balance minus my prepaid expense. Then I end up with 1,885,000. Then I come now and say, once I have a prepaid expense, it is receivable. So I add it over there. Next adjustment. Thank you. It reads, rent income. Rent income includes the rent for March 2023 received from the tenant. Are we supposed to receive for March? No, we must receive until February. The monthly rent was increased by 1,170 on the 1st of January. The easiest way is to take out the increase. Okay, let's do that. So we now say from the month of when it was increased, from the month of January, it's January 1 until March. How many months is that? That's 3 months. In those 3 months, rent has been increased by 1,170. So if we punch this in the calculator, you realize that we have received 3,510 of the increase. So if we come here and we say our 89,700 minus that increase of 3,510, we will then get rent before increase, which is 86,190. This is rent before increase. Once we get rent before increase, then we can divide it by 13 months because we have received rent for March. So it's not 12 months, it becomes 13. And then we now say rent per month, therefore, is 6,630. This is rent before the increase. All right. So we then say 6,630 before the increase plus the increase. How much is the increase? 1,170. This therefore gives us 7,800. This is the rent per month after increase. When I have my rent per month after increase, I can come to my rent income of 89.7. Subtract now the income received in advance, and then I end up with 81,900. Remember, income received in advance is a payable. In this question, they wanted us to do the assets part of the statement of financial position. Can I go to the next adjustment? It reads, loan from Pearl Bank. Interest on the loan is capitalized, has not been recorded. Fixed monthly repayments, including interest, have been paid and correctly recorded for the financial year. Interest on the loan amounts to 60% of the monthly repayments. So what we will do, we want to know how much is the repayments. So we will take the 690, which is what we had at the beginning in 2022. Then we subtract what we are having now, 524,400. The difference between these two amounts gives you 165,600. This is the total repayments. So when I have my total repayments of 165,600, I am then told that the interest on the loan is 60% of the monthly repayments. So I need 60% of that. Once I get my 60% of that, that is my 99,360. That therefore becomes my interest expense. Where do we show it? We come now to our statement of comprehensive income. We have our profit before interest expense. We bring interest expense, 165.6 times the 60%, 99.3. Remember to put your interest expense in brackets. We are coming now to the end of this activity, and one of the things that was required was to complete the bottom part of the statement of comprehensive income. So we had net profit before tax, and the income tax we have. Income tax is 858,140, and what we needed to get was the net profit before tax. So we are doing the bottom up. So what we then do, we change the sign of this income tax. Hence, you will now say 2,002,500 plus the 858,140. That is how you end up with your 2,860,640. Once you have that, the next thing that must come to your mind is, do we owe SARS in relation to tax, or SARS owes us? What is the simplest way to do that? You simply have to know what must be paid, what we should have paid. I'm going to write it here as should be paid. What should be paid to SARS is the income tax amount here, which is 858,140. But we have what is known as provisional tax payments. So these are payments that have already been made, paid already. How much has been paid? 875. So here's the situation. We have what was supposed to be paid, and we have what was paid. So what do you think? We have paid 875 when we should have paid 858,140. Who owes who? We paid SARS more than what we should have paid. How much more did we pay SARS? You get the difference between these two amounts, which is your 16,860. Therefore, that money is due to us by SARS. What does that become? It becomes a receivable. Hence, you see 16,860 receivable to us from or by SARS. All right, we've come to the end of this question. But if you checked when I started today's class, I gave you several options in which question 1 can be tested. And I'm going to address the second aspect to it. And we have an extract from the Free State Prelim for the year 2022. In this question, they were testing on the calculation of the correct net profit after tax. All right, so we're going to do this question. Make sure you have a clean piece of paper to write this. Keep the calculator closed. Let's go and see. And then here we have information that was given, the information that was given. And one of the most important things that I always want you to take note of is the SARS income tax, the 300,000. Towards the end of this question, I'll ask you if you still remember how much was the provisional tax payments. So write it somewhere. Provisional tax payments. Okay, let's see. We were given the net profit before tax to be 1,089,238. It was determined before taking into account the following information. What must we do? Let's take the following information into account. Let's start with the first one. Okay, here is more information that still needs to be taken into account. Remember what I said? Remember the provisional tax payments? I'm going to talk about it as we come to the end of this question. Let's begin with the first adjustment. It reads, the net profit before tax of 1,089,000 was taken before. This was taken into consideration. Provision for bad debts must be adjusted to 7,800. Remember, we spoke about this earlier on, and we agreed that you have provision for bad debts, which is 2. The 2 goes to the balance sheet. But here we are doing the calculation of correct net profit. That means we are looking in the statement of comprehensive income. What do we want? We want either an increase or a decrease. All right? So we would then say, how much was it last year? Here is my last year, 10,600. How much is it this year? This year, it is 7,800. What do you see? This is a decrease. A decrease of how much? 2,800. And you remember what I said? An increase is an expense, but a decrease is income. It therefore means when we got this net profit of 1,089,238, there is income that was not recorded, which is 2,800. Hence, you see, I'm coming here to say plus 2,800. Why? Because here I have a decrease in my provision, and a decrease is income. So I have income that must be recorded, taken into consideration. Therefore, my net profit is going to increase. Hence, you see the plus sign, plus 2,800. Can I move on to the next one? Let's go. The next adjustment reads, an invoice was issued on 30 June for 8,712. A 10% trading discount was allowed. So that means this amount that I have, which is 8,712, is after discount. If it is after discount, I know that before discount, I was supposed to get 100%. Then there was trade discount of 10%. Therefore, after discount, I'm getting 90. Therefore, it means this 8,712 is actually how much? 90%. That's 90%. Let's go in here. Now, goods were sold with a markup of 60%. No interest been made of this transaction. So we need to record this transaction. Now, what we know is we have sold goods and we have received. How much have we received? We have received, okay, it's an invoice. We have sold goods for 8,712. Okay, so that is the amount that we have sold for. We now need to come and subtract the cost of sales such that we can now see the profit on these goods, that we can now add it to the profit that we have. But if I come here and I want to calculate profit, first, I have to come back to the original price that we were supposed to have sold the goods before the discount. How much was it? Then I can then calculate the cost of sales. So if I come and I want to calculate the cost of sales and I say, if I say 8,712, multiply this by 100 over 160, this is wrong. You can't do that because there was trade discount that was given. So we need to know how much was it before the trade discount. So what we want is, we want 100. You remember this 100 here. But what do we have? We have 90. How do we know it's 90? Here, after discount. So we have 90, multiply that by your 8,712. This will give me now the amount that was supposed to be the sales before discount, that is 9,680. When I get this 9,680, I can then calculate my cost of sales. So I now say 9,680. Multiply then by 100 over 160. Then I punch that in my calculator, I get 6,050. This becomes my cost of sales. So I can come back here now and say, this is what I sold the goods for, but the cost of these goods was 6,050. Therefore, how much is my profit? And you realize that your profit becomes your 2,662. And since this is profit on sale of goods, it's going to increase my net profit. That's why you see I have a plus over there. I have a plus 2,662. Can I move on to the next adjustment? Okay, thank you. Here is the next adjustment. And it reads, the auditor discovered that the trading stock deficit was a trading stock surplus. So if we had a trading stock deficit, how did we record it? We subtracted it under our operating expenses. That means our profit was decreased by 5,600. All right. Now we realize that that deficit was actually a surplus. So to correct that, what do? We come into our correct net profit. We record the first 5.6. So it's 5.6 to cancel the error that we had done, where we recorded a surplus as a deficit. Therefore, we come back to 0. Then we come and add another 5.6. Then we have now added 11.2. Remember, it is a surplus. So trading stock surplus is recorded under other operating income. It will increase my net profit. Hence, you see a plus. My net profit was understated because I recorded an income as an expense. Now I come and record that income not once, but twice. First, to cancel the error. Secondly, to record the proper way. So that is why you find I have 5.6 plus 5.6. All right? I hear people saying, Mr. Simbi, move on. I'll do that. The next adjustment reads, consumable goods on hand at the end of the year amounted to 5,400. So these are goods on hand. What that means is we have consumable goods that we purchased, and we did not consider that we did not use the entire amount. 5,400 is still on hand. What that means is our expense was overstated because we recorded the entire amount of consumable stores. Hence, our operating expenses were overstated. The right way then would be that we come and we add it to our net profit. Hence, you see the 5.4. When an expense is overstated, it decreases the net profit. The correction is to add it back so that our net profit can be corrected. Hence, you see consumable goods on hand that were not recorded, we added to our net profit in the calculation of correct net profit. Let's go on to the next adjustment. It reads, the director's fees paid for the year amount to 648,000. The company has 5 directors who received the same fee. All right, you know already what I'm going to do. Okay, let's bring the directors. Director number 1, director number 2, director number 3. Where is number 4? Number 4, how many did they say we have? We have 5. Here's director number 5. 5 directors. They say, one of the directors asked the company to only pay out his fees for the last 6 months in July 2022. When is July 2022? The next financial year. So, what does that mean? It means for director number 1, we paid him for 12 months. Director number 2, 12 months. Director number 3, 12 months. Director number 4, 12 months. But for director number 5, he has asked that we don't pay him for 12 months. He has planned a vacation overseas, so he needs money to spend over there. So he said, please only pay me my director's fees in July. So we have paid him not for 12, but for 6 months. In total, let's add this. How much do we get? So we're saying 12 plus 12 plus 12 plus 12 plus 6. That is going to give us 54 months. What it therefore means is, on the director's fees that we have, which is my 648,000, this is for 54 months. This is for 54 months. That means director's fees per month, per director, is 12,000. So if we have not paid this director for 6 months, how much do we owe him? We owe him 72,000. It therefore means when we come to our calculation of correct net profit, we have an expense that we have not yet recorded. It must therefore decrease our net profit. Hence you see here, I have a minus 72,000 because one of the directors was not recorded as 12 months. It was recorded as 6 months. If we are owing an amount in this question, the question wanted the calculation of correct net profit and the liabilities section of the statement of financial position. We therefore come here and we have our trade creditors and we have our amounts payable, and then we are now going to say this is the director's fees that should be paid to the director. Next adjustment, let's go. It reads, BE Builders was paid 120,000 for the construction of a storeroom, 90,000. Okay, so the construction is 90,000, and repairs, we know that repairs are what? An expense. The entire amount was debited to the land and buildings in error. So what they're trying to tell us is we have an expense that was not recorded. An expense that was not recorded. When an expense is not recorded, our profit is overstated. What do we then do? We come and then we say minus 30,000 because an expense was not recorded. Very important. Minus 30,000. Next adjustment, dear learners. And it reads, rent for July 3,300 was received in advance. So the rent for July was received in advance. When we have rent received in advance, what does that mean? It means on our profit, our profits were overstated. We recorded more because we have 3,300 which was received in advance. Were we supposed to record it in this financial year? No. So our profits were more. What must we do? We come and we subtract 3,300. That is how we correct the net profit. Can I repeat that? Our income was overstated. Hence we come and we say minus 3,300. But now, considering that we have received income in advance, income received in advance should therefore be recorded under our trade and other payables. Hence, you see it here. I want to encourage you. If an examiner brings such a question, you must be able to do the two at the same time. Your statement of comprehensive income or the calculation of correct net profit, and keeping in mind that I'm also answering the statement of financial position. Either it's the assets or it is the equity and liabilities section. Okay, can we move on? Thank you. Let's go. The next adjustment says, advertising includes a 6-month contract for 7,200 with the local newspaper. This amount was paid for the period 1 May to 31 October 2022. Okay, so remember our financial year is ending in June. You have to keep that in mind. Remember the 10 minutes reading time, that is where you need to keep that information. This financial year ends in June. Okay, so we are now told that we have paid from the 1st of May to the 31st of October. Okay, And how much have we paid? We have paid 7,200. If you count from May to October, how many months do you see there? This is 6 months. Now, how many months are falling beyond the financial period? So we're counting from July to 31 October. How many months are those? Remember the finger story, okay? July, August, September, October. So you have 4 months that are falling beyond. 4 of the what? 4 of the 6. You multiply this by 7,200. That will then give you the amount that was paid in advance. All right? The simplest way was to say 7,200 is for 6 months. How much is it per month? 1,200. How many months we paid in advance? 4. Multiply this by 4. That will give you 4,800 again. Okay? You like the second method, I know. All right. So we then say, if we have paid 4,800 in advance, how does it affect our net profit? So we have an expense that was overstated. When the expense is overstated, net profits or profits are understated. How do we correct that? So we go and we add this 4,800 to our incorrect net profit. So we come here, we say plus 4,800. That is how we then correct it. Okay. The next adjustment, it reads, income tax amounts to 334,564 for the year. Do you remember what I said at the beginning of this question? Yes, we spoke about what? Provisional. I spoke about provisional tax payments. Who still remembers how much it was? Yes, it was 300,000. Remember what I said? I'm going to ask you this. We've come to the moment where I ask you. So it was 300,000, the provisional tax payments. Okay? And then it means we need to record it in our calculation of correct net profit. So we have the correct net profit before tax, and then we subtract the income tax, which is that one. Then we now have our net profit after tax. But every time you see the examiner bringing this, they will likely test you on the amount that we owe to SARS or the amount that SARS owes to us. In this case, what do you think is the case? All right, what should be paid? Do you remember what we said? What should be paid, what should have been paid is 333,564. But what was actually paid? Provisional tax payments, 300,000. At the end of the day, who owes who? We or SARS? How much? 33,564. Because we should have paid, but we have paid. We must still pay 33,564. Therefore, it will come. All right? It will therefore come under your current liabilities. There you see, and I have my 33,564. All right. It is very important, dear learners, that you practice this kind of questions. All right. Dear learners, we're going to take a very quick break of about 5 minutes. We're going to take exactly 5 minutes break. And then when I come back, I want to do an exciting question with you. I'm going to go back again to the NSC June 2023 paper. Do you know which question I'm going to do now? If you want to see, please join me again after the next 5 minutes. See you briefly.
I want you to ask yourself these 3 questions. Number 1, what do I want? Do I want to become an A student, or do I want to become an average student? Number 2, I want you to ask yourself, how do you plan on getting there? Are you going to put more extra hours, or are you going to just sleep? Number 3, who will be with you in this journey? Because it is important that we associate ourselves with students who have the same vision as us, who want to become a student, who want to put in the extra work, who want to become better at what they do. Unsuccessful people do not plan. They just let life happen to them. But successful people are planning on how they want their lives to be. And right now, you plan on how you want your results at the end of the year to be like.
Welcome back, dear learners. Before the ad break, I promised you that we're going to do an exciting question. And what I have here is an extract from the NSC June 2023 paper 1. Okay, let's see what we are required to do. So in this question, we are required to prepare the retained income note for the year ended 20th February 2023. So we're doing the retained income note. All right, let's see more information that we're given that relates to the statement of financial position. Okay, let's therefore begin with our calculations. What we want to do, as I've already said, we want to do the retained income note. So we are given the balance at the beginning of the year that was given, and the net profit after tax was also given. The next thing that we must then record is the repurchase of shares. So I would come here and I would say the repurchase of shares. Immediately I must open my bracket because I want my teacher to see what I am doing. Calculations are very important. How many shares did we repurchase? You see here we have repurchased 180,000 shares. So I'll come here and I'll say 180,000 shares. But how much do I then bring here? Remember, you will have to know the calculation. There are several ways in which you could have done this. There is the triangle approach, and there is the simplest way, which is simply to say the difference between what was paid and the average price. So remember, you're going to get your repurchase price, and you have your average price here, and then you have your difference. I've seen different ways of writing this on the triangle. It's not a problem at all. So one of the things that we need to get is the average price. All right. So for us to get the average price, we know how much our shares were at the beginning. The ordinary share capital here is given, which is 12,312,500. Because the repurchase of shares is happening before the issue. The repurchase is happening before the issue. So for me to get the average price, I come to my amount that is already in the extract of the statement of financial position, because there was no change as there was no issue of shares. So my average price is still the same as it was at the beginning, considering that average price will change when shares are issued. So since no shares were issued, I will then come and say my 12,312,500. I divide that by the number of shares that I have at the beginning, which is my 1,250,000. This would then give me my average price of, please punch that in the calculator, how much do you get? 9 Rand 85. So I can come here and say my average price is 9 Rand 85. Okay, then they say the shares repurchased, they do not qualify for dividends. And EFT, this simply means this is the money we have received. Okay, this is the money that we have received. We have received 1,989,000. But we have received that for 180,000 shares. How much was it per share? How much was it per share? Okay, so the amount, an EFT was issued, so that is what we paid, what we paid. So we're coming here to say 180,000. So it's 1,989,000 divided by 180,000. We want to know how much we paid per share. So here we say that divided by the 180,000, we then get 11 rand 5 cents. So we have paid 11 rand 5 cents. So what we paid minus the average price gives us the difference. The difference is what goes into your retained income. So we say 11 rand 5 cents minus 9 rand 85. It gives you 1 rand 20. 1 rand 20 is what we bring into the retained income. So I'll then come and say the repurchase of shares is 180,000. Multiply that by 1 rand 20. And then I know that on my repurchase, I must always have my bracket, and my amount becomes 216,000. So that becomes my repurchase of shares. Okay, let me move on. So on the next aspect, I now need to go. Remember, I've already been given that and we've calculated that. So the next thing I need to do is to get my dividends. And here I need interim dividends. And we're told an interim dividend of 32 cents per share was paid on the 31st of August. So dates are very important. On the 1st of March, this is the 1st of March. On the 1st of March, I had 1,250,000. And then on the 1st of May, I repurchased 180,000. Okay? And then before these shares were issued, an interim dividend was then issued. So how much was that interim dividend that was paid? For me to get the number of shares for the interim dividend, I would then say my 1,250,000 minus my 180,000 shares that were repurchased. How many shares do I have that qualify for dividends? Please punch that in the calculator. And 1,070,000. You are correct. So we get 1,070,000 shares. Now I want to know what was the dividend per share, 32 cents. Okay. Now I want to encourage you to show your calculations here. So you're coming here to say 1,070,000. Multiply that by your 32 cents. And then how much you get here then? You get your 342,400. That is what we end up with on the interim dividends. All right. And then the next aspect that we need to get is the final dividends. Now, the exciting part about the final dividends is they told us that a final dividend was declared. So, are they paid? No, declared. Remember, these are your liabilities. So if I'm to look for them, I would find them in the statement of financial position. All right. Therefore, there is my final dividends. I would then come and I have my final dividends. I would add my 342 and the 575 to give me 917. Then I'm now taking it from the top to the bottom because this was given, and we calculated that. All right. And then we subtract that as well. And then we end up with a balance of 629,600. That was easy. Yes, that was easy. All right. Let's quickly go on to the next activity, which is my last activity for the day. My last activity for the day is from the NSC June 2023, paper 1 again. So we're still in the very same paper. All right, there it is. And I am going to look at questions which relate to the cash flow statement. Okay, here it goes. It says, calculate the following figures for the 2023 cash flow statement. Number 1, change in loan. Change in loan we have two ways. An increase in the loan means we have received the loan, cash inflow. A decrease in the loan means we have paid back the loan, cash outflow. In this case, remember what I said, we look at our financial statements from the right going to the left. So in 2022, it was 7,200,000. Now it's 6,348,000. Is it increasing or decreasing? It is decreasing. Why would a loan decrease? A loan would only decrease when we have paid that loan. Remember, payments, cash outflow, repayment of loan. But they don't want all of that in this particular question. They said calculate the change in loan. So for the change in loan, I would therefore take my loan in 2022. Then I subtract my loan in 2023. And I realize that I have a change of 852. They wanted the change in the loan. You must listen to the examiner's instructions carefully. At times they would want to know how much was paid on the loan, how much was received from the loan. Here they just wanted the change in the loan, which is 852. Remember, when we pay a loan, cash outflow. When we receive a loan, cash inflow. I'll go on to the next aspect. It says, calculate the following figures for the cash flow statement. Proceeds from shares issued. Proceeds from shares issued. Let's see if we have information. Okay, so remember we have dealt with this piece of information earlier on when we did the retained income note. So we are familiar with what is happening here. But we want to know, here they said, shares were issued at 11 Rand 40. Do we know how many shares were issued? Do we know? So we need to know how many shares were issued. So one of the things that you would be familiar with is your note number 7. Your note number 7, your ordinary share capital note. Here on the left side, that is where you bring your number of shares, remember. So here you're going to have 1,250,000. That is your shares at the beginning. Then you now come and say repurchase, which is your 180,000. And then we don't know how many shares we issued, but after that issue was done, at the end of the year, we had 1,370,000 shares. So it becomes easy then for you to get this number of shares that was issued here. What do? The bottom up. When you go up, you swap the signs, you change the signs. So you'll be saying 1,370,000 plus 180 minus 1,250,000. Then you get the number of shares. Can I say that again? It's 1,370,000 plus 180,000 minus 1,250,000. That is how you end up now with the answer. How much is that going to be? 300,000. So we have issued 300,000 shares. Now we know this one. We issued 300,000 shares. So if we issued 300,000 shares, and we know that we issued them at a price of 11 Rand 40, how much are we going to receive from the issue of shares? So we say 300,000 multiply by 11 Rand 40. That will give you 3,420,000. 3,420,000. 3,420,000. So this was one of the ways of getting this. This was one of the ways of getting this. And I would consider this to be one of the easiest ways that you could have used to get these proceeds from issue of shares. Then the next one would be to use the rand values then, the rand values. All right, the rand values, we are simply saying how much were we having here at the beginning. Here at the beginning, remember, we had 12 million here, 12 million, 312,500. That is what we had at the beginning, 12,312,500. And here at the end, we are having 13,959,500. Okay? And then we know that on the repurchase of shares, remember the one where we calculated the average price, we are told that shares repurchased, we have made an EFT of that. But we know that when we calculate the repurchase of shares, we use the average price. And you remember when we calculate the average price here, when we took this and we divided it by 1,250,000, you remember that we had 9 Rand 85. So if we come here and we say 180,000, then we repurchased at 9 Rand 85. In note number 7, we record the average price. So that means here, I'm going to now say your 180,000. 180,000 times the 9 Rand 85. Please punch that in your calculator. 180,000 multiply by the 9 Rand 85. You will get your 1,773,000. So you end up with 1,773,000. There it is. So once you have this and you have that and you have this, you can then get the 3,420,000. That therefore becomes easy. Okay, here is the calculation. So here's the first method that I did where we got the 300,000 multiplied by that, then you end up with that. And here's the second calculation where you use the rand values. What I was trying to emphasize is you must know your notes. Note number 7. So you can still use your note number 7 to answer this particular question. But remember, time is very, very important. You don't need to spend much time on one question. Once you are done with a particular aspect, you must move on to the next question. As I said at the beginning of this class, you need not to leave any blank space. You must study and you must cover all areas. As I said at the beginning, your statement of comprehensive income, the calculation of correct net profit, is very important that you cover those things. Statement of financial position, the cash flow statement, analysis and interpretation, and then we spoke about corporate governance as well as auditing. Dear learners, as we have time over this weekend, before we write the paper in this coming week, you have enough time to sit down and study. The lesson that we have had today, please, you can still rewatch it again when you have the paper in front of you and see how we were doing these calculations. I want to encourage you. We can only achieve well from practice. Do not despair. You still have time to study. So we have come to the end of today's class, and I'm hoping that we're going to meet again very soon as we continue to prepare for the paper that is around the corner. I believe that you can do it. You need to start believing that you can do it as well. Until next time, it is goodbye.